We have some viewer mail.
Good. I like viewer mail. If you have any questions, please send them to doug@riskandrewardtv.org, and I will try to get to your viewer mail questions as well.
And it's Steve this time, and he was asking, what is a PE ratio and what does it mean?
Excellent question. PE ratios are bandied about all the time, and we should know what they mean. It's a simple ratio, which is price, P, divided by earnings, E. So it's price per share divided by earnings per share, and it gives you a number that basically is the price you pay for $1 of earnings. So that's your PE ratio. So let me give you an example. If we look at Apple, which is a hot stock, you've got it's $320 per share, and they made $15.15 in earnings in the trailing 12 months of the last 12 months. So you've got a PE ratio of 320 divided by 15, and that equals about 21 something. So they've got a PE ratio of about 21. So if you invest 21 of your dollars, you get a claim as an owner of $1 of their earnings. Does that make sense?
Yes.
Okay, so now if we take that and we turn that around a little bit, we can do an equation and say, what is $21 of their earnings times what percent return equals $1? So now we can figure our percent return on our investment of $21.
Okay.
And so all we do is take the dollar and divide by 21. And that would equal about 4.7%. So if you have a 21 PE ratio, you have about a 4.7% return on your money. Okay?
Okay.
So the higher the PE ratio, the lower the percent you're going to get for investing your money. On the other hand, this is trailing 12 months earnings, not next 12 months earnings. So obviously you're looking forward, and when you think about Apple, you're going to think about, well, they're going to be growing, and they got iPhone 15 coming out, or whatever it is.
Just wait to see what's coming up next.
Another new iPad, and so on and so forth. So it's kind of misleading. So certainly the PE ratio isn't a great measure. It is a good measure. A lot of people look at it, but it's not a great measure. So for example, let's take a different company. Let's take Johnson & Johnson. Now, Johnson & Johnson is a biotech medical firm that's big. It's been around for a long time, but it's not a tech-growing company like Apple is. So you would think that its PE ratio would be lower. Well, if we do the Johnson & Johnson math, we get about $62 in the share price, and their earnings was 4.87 last time I looked, which is about 12.8 or so for a PE ratio, and if you do 1 over 12.8, you end up with about 7.7% return. So Johnson & Johnson's PE ratio being lower than Apple's, if you invested your money into Johnson & Johnson, you would get about a 7.5% return.
Pretty decent return.
Right, so you would have a claim on their earnings of 7.5%. The stock price can go all over the place. That doesn't mean you're going to earn that.
Right.
It's just that the claim on their earnings would basically give you a return of 7.7%. And of course, it's an ongoing business, and there's a lot of other factors involved. But that's why PE ratios are talked about so much, is the higher the PE ratio, right, the less return for investing in that stock. So you want to think to yourself, high PE ratio, is it really going to keep growing at this pace? Now, the Standard & Poor's 500, if you add up all the PE ratios of all the earnings of the S&P 500 and all the stock prices of the S&P 500, you can get a PE ratio for the S&P 500.
And what is it?
Well, currently it's 22.7 or so last I looked. So the S&P 500 PE ratio, and I, quite frankly, I didn't look right before I came in here. I'm doing this by memory, so I could be off. But that gives you about 4.5%, 4.4% or something return. And as you know, stock prices have been running up, right? So stock prices have been running up. You get a PE ratio that's a little bit lower. But that's past earnings. If earnings continue to grow, obviously that's going to impact the PE ratio. So when you hear people talking about PE ratio, it's just a relative measure of how much your return would get if you invested in your money into the company based on its past earnings. You can also look forward at its future earnings and get a PE ratio that way if you want to get more complicated with it. But that's why people talk about PE ratios. It gives you an ability to look at the return of the company in a very short way. It's a quick and dirty way to look at a company. And of course, if they have negative earnings, you can't do a PE ratio at all.
You get
It's
no
useless.
money back.
Well, it's useless. If you have negative earnings, you can't do a PE ratio because you have no E. So there you go.
So a lot of those bank stocks.
Well, yeah, the bank stocks.
E.
E. I mean, I don't know which banks are currently have negative earnings. I'm sure B of A, Citibank, Citigroup, or whatever probably have negative earnings. They have no PE ratio. You can't use it as a measure.
All right. Well, what's your
What's
takeaway?
Takeaway is the PE ratio is a quick and dirty look at a company, but it can easily be misinterpreted and should never be used as the sole factor in stock selection.